Hey everyone, and welcome back to the channel. Today we're talking about something that will affect every single one of us, your money and your taxes. The year 2026 might seem far away, but a massive financial shift is coming, and if you're not prepared, it could cost you thousands. This isn't just another small tax update. We're talking about the biggest tax law changes in nearly a decade. What you do in the next year could determine whether you pay a lot more or save a lot more when these changes hit. So, stick with me, because by the end of this video, you'll have a clear roadmap to navigate what's coming and protect your wealth. So what's the big deal about 2026? It all comes down to something called the Tax Cuts and Jobs Act, or TCJA. You probably remember it from back in 2017. It was a huge piece of legislation that dramatically changed the tax landscape for individuals and businesses. It lowered tax rates, nearly doubled the standard deduction, and changed a bunch of other rules. Here's the critical part. Most of the individual tax provisions in the TCJA were temporary. They are set to expire or sunset at the end of 2025, unless Congress acts to extend them. Our tax code will automatically revert back to the rules we had in place before 2017. This is what we call the tax cliff, and it's a big one. Let's break down exactly what's changing. First, and most importantly for most people, are the income tax brackets. Right now, we have 7 tax brackets with rates of 10, 12, 22, 24, 32, 35, and 37%. If the TCJA expires, those rates will jump back up. The new brackets would be 10, 15, 25, 28, 33, 35, and 39.6%. Notice that nearly every bracket goes up. The 12% bracket becomes 15%, the 22% becomes 25%, and so on. This means that even if your income stays exactly the same, your federal tax bill will go up. For a middle-income family, this could easily mean paying thousands more in taxes each year. It's a direct pay cut from your take-home pay, and it's coming for almost everyone. Next up is the standard deduction. This was one of the most popular parts of the TCJA. It nearly doubled the amount you could deduct without itemizing. For 2024, the standard deduction is around $14,600 for single filers and $29,200 for married couples filing jointly. In 2026, this is scheduled to be cut roughly in half, adjusted for inflation. This is a massive change. Why? Because over 90% of taxpayers now take the standard deduction. It's simple, and it saves a lot of people money. When it gets cut in half, millions of people who previously didn't need to itemize will suddenly find themselves needing to track every little charitable donation, medical expense, and mortgage interest payment just to get a tax break. It will make filing taxes more complicated and, for many, more expensive. Another huge change is the state and local tax deduction, also known as the SALT deduction. The TCJA capped this deduction at $10,000 per household. This was a major blow to taxpayers in high-tax states like California, New York, and New Jersey, who often pay much more than that in property and state income taxes. In 2026, this $10,000 cap is scheduled to disappear. On the surface, this sounds like great news for people in those high-tax states. They'll be able to deduct their full state and local tax payments again. However, there's a catch. The return of the unlimited SALT deduction comes at the same time as the return of something called the PEAS limitation, which reduces itemized deductions for high-income earners. So while you might get the full SALT deduction back, other deductions could be limited, potentially washing out some of the benefit. Let's talk about families. The TCJA also made big changes to the child tax credit, doubling it from $1,000 to $2,000 per child and making more of it refundable. This was a significant boost for families across the country. In 2026, this credit is set to revert back to its pre-TCJA level of just $1,000 per child. Not only that, but the refundability rules will become much stricter, meaning fewer low-income families will see the full benefit. A family with 2 kids could see their tax credit cut in half, from $4,000 to $2,000. That's a direct hit to the family budget, making it harder to pay for things like childcare, groceries, and school supplies. Now, let's shift gears to business owners and investors. The TCJA introduced a very valuable deduction called the Qualified Business Income, or QBI deduction. This allows owners of pass-through businesses like S-corps, partnerships, sole proprietorships to deduct up to 20% of their business income. This was a game changer, effectively lowering the tax rate for millions of small business owners. You guessed it, the QBI deduction is set to completely disappear after 2025. This means that if you re a business owner, your taxable income could suddenly jump by 20%. This is a massive tax hike on the engine of our economy's small businesses. Planning for this is absolutely critical. For those of you with larger estates, there's a big change on the horizon as well. The TCJA doubled the estate and gift tax exemption. For 2024, it's a whopping $13.61 million per person. This means you can pass on that amount to your heirs without paying any federal estate tax. In 2026, this exemption amount is scheduled to be cut in half, back to around $6 to $7 million, adjusted for inflation. If your net worth is in that range or higher, you need to start your estate planning right now. Strategies like gifting and setting up trusts become much more important to minimize a potential 40% estate tax bill. This is a use it or lose it situation. The window to take advantage of the higher exemption is closing fast. So, with all these changes coming, what can you actually do about it? It's not about panicking. It's about planning. The next year and a half is a critical planning window. First, consider accelerating income into 2024 and 2025 while tax rates are lower. If you have the flexibility, can you take a bonus early? Can you realize some capital gains now? On the flip side, you might want to delay deductions until 2026 or later, when they will be more valuable against higher tax rates. One of the most powerful strategies to consider is a Roth conversion. With tax rates set to rise, it might make sense to convert some of your traditional IRA or 401k funds to a Roth account. Yes, you'll pay taxes on the conversion now, but you'll be paying at today's lower rates. Then, all that money can grow tax-free forever, and you won't have to worry about what future tax rates will be. This is a powerful tool, but it's complex. You absolutely want to run the numbers with a financial advisor to see if it makes sense for your specific situation. Don't just do it because you heard about it online. Make sure it fits your long-term plan. If you're a business owner, now's the time to reevaluate your business structure and compensation strategy. With the QBI deduction disappearing, the tax advantages of being a pass-through entity will shrink. You should talk to your CPA about whether your current structure is still the most tax-efficient for the post-2025 world. And for estate planning, as I mentioned, the clock is ticking. If you want to use that high gift tax exemption, you need to act before the end of 2025. This could involve gifting assets to family members or moving assets into specific types of trusts. This is high-level financial planning, so working with an experienced estate planning attorney is non-negotiable. Globally, it's important to remember that U.S. tax changes can have ripple effects. For American expats, the reversion to old rules could make things more complicated, especially with things like the foreign earned income exclusion and how it interacts with tax credits. Major global economies are watching what the U.S. does. Significant. U.S. tax hike could alter international investment flows and corporate decisions about where to headquarter their operations. The global tax landscape is always shifting. To change this big in the world's largest economy will definitely make waves. Now, will Congress do anything? It's the multi-trillion-dollar question. It's very likely they won't let all of these provisions expire without a fight. We'll probably see a lot of political maneuvering and negotiation in late 2025. Some provisions might be extended, some might be modified, and some might be left to expire. But waiting to see what happens is a risky strategy. The best approach is to plan based on the law as it's currently written. Hope for the best, but prepare for the tax code to revert. That way, no matter what Congress decides, you'll be in a strong financial position. We've covered a lot today, from income tax rates and deductions to business and estate planning. The key takeaway is that 2026 is going to bring a seismic shift to our tax code. Ignoring it is not an option if you want to protect your financial future. Start the conversation now. Talk to your spouse, talk to your financial advisor, talk to your CPA, build a plan. The actions you take over the next 18 months will have a direct impact on your wealth for years to come. I know this can feel overwhelming, but knowledge is power. You are now way ahead of most people who have no idea this is even coming. If you found this video helpful and want to stay updated on these changes as we get closer to 2026, do me a huge favor and hit that like button. It really helps the algorithm show this to more people who need to hear it. Make sure you subscribe and turn on notifications so you do unmiss any of our future updates on this topic. I want to hear from you. What's the one change that you're most concerned about? Let me know in the comments below. Let's start a conversation and help each other get prepared. Thanks for watching, and I'll see you in the next video.